Hi there, everyone. Welcome to Chart This with Dave Keller. Happy Monday, October 28th. I'm your host, Dave Keller, coming to you from a beautifully overcast and not too hot, kind of cool Redmond, Washington. Thanks for joining me every weekday after the close as we break down the market action using the best practices of technical analysis. I'm actually here in the Stock Chart studio, which they've been kind enough to let me use, which is pretty awesome. I was actually just in Seattle meeting up for lunch, which is why we're getting a bit of a late kickoff here. Meeting Sean McLaughlin of All Star Charts, one of my charting brothers from in town from Colorado, to watch his Buffalo Bills dismantle the Seattle Seahawks yesterday. But good to meet him for lunch and catch up. Sean's an awesome guy, and shout out to the team at All Star Charts. You know, today looking at the markets, we're going to talk a little bit about this, sort of choppy sideways session. The S&P opened a bit higher, kind of spent most of the day in a choppy sideways move. The real story today would be small caps up about 1.5% for the S&P 600. But also this week, all about earnings. 5 of the magnificent 7 stocks reporting this week. A lot of other stocks in a lot of different sectors all reporting this week, finishing with a big energy day on Friday. So there's going to be plenty of things to talk about through the course of this week. Also, preliminary GDP numbers, some more housing data, inflation data. The PCE comes out later this week. So we'll have plenty to talk about here, but we'll, of course, as always, focus on the charts. As a reminder, I can see whatever comments you're putting on whatever platform you're on. We're currently live streaming to Facebook, LinkedIn, YouTube, and X, and I appreciate so much you tuning in wherever you're at and on whatever platform. Just drop a comment on whatever platform, unless it's a Go Yankees thing, Jeremy. You can take that right back with your Go Yankees as a lifelong Indians and now Guardians fan. Don't rile me up. All right, let's continue on with today's market recap. You got under my skin already. We haven't even started the show. All right. Looking at the major averages here, the S&P 500 up about 0.25% to 58.23 and change. But again, if you look at the preview chart on the left side of your screen, you can see we kind of opened higher. Most of the day was actually flat to slightly down. And so that's kind of the configuration that we experienced today. The S&P really not a dramatically positive day, I would say. The real action was kind of underneath the hood with other names. Mid caps up 1%, small caps, the S&P 600 up 1.5%. And that's sort of an unusual configuration that we haven't observed a lot here in 2024. That's sort of, small over large. That's not been the general tendency in 2024. The small cap index is much less attractive from a trend perspective than large caps and especially mega caps. Large cap growth versus small cap. It's not even been close. That large caps have been the play. So certainly something to observe as we have a bunch of mega cap companies reporting earnings this week. The VIX continuing its own volatility. The VIX of the VIX, pretty noisy here. The volatility as defined by the VIX a little bit lower today, down about 0.5 VIX point to back below 20. And so we're kind of toying around with that 20 level, which is sort of my basic cutoff between a high volatility environment and a low volatility environment, right? VIX over 20 is what most, if not almost all, pullbacks I've ever experienced, or certainly corrective moves, you've seen the VIX push above 20. So something to keep an eye on for sure here. All right, looking at some other asset classes, we can see interest rates, generally speaking, moved a little bit higher. 10-year yield finished today just below 4.3%. The long bond yield just about 4.5%. Bond prices were down slightly here. In the dollar index, honestly, no real change from Friday's close. So the dollar has been trending higher. That's been an interesting sort of change of configuration in the month of October. Previous 3 months, July, August, September, weaker dollar. October, all of a sudden, a stronger dollar. Rates going up. A lot of things have sort of pivoted in the month of October. Not stocks, though, right? The S&P 500 arguably still in a primary uptrend. I don't think that's arguable. I think that's pretty clear cut. Looking at the commodity space, again, kind of a quiet day with certain charts. Gold essentially unchanged. Silver about the same. Copper prices. Crude oil down big, though, right? So you can see the USO, which is a crude oil ETF, down over 5%. The natural gas ETF, UNG, was down almost 8% today. So energy feeling the weight of things here. Cryptocurrencies, kind of a lot of green here. Over the weekend, you've seen Bitcoin actually mount a pretty decent attempt to get back above 70,000. I would argue that's a level kind of in play right now. Currently, Bitcoin's just around 69,600. We are a hair's breadth away from 70,000. We've been below 70K. We've sort of been in that basing pattern below resistance for quite some time. I do have a chart of Bitcoin to look at here in a little while. We'll talk about what that breakout could mean in terms of the size and length of the base. When you finally break above there, that's often a pretty significant bullish signal. All right, looking elsewhere at the 11 S&P sectors, financials at the top of the leaderboard. Now, a lot of the financial stocks reported a little earlier in earnings season. There's some of the first reports from, like JP Morgan and Citigroup type of names. Those were a couple weeks ago at the beginning of Q3 earnings. Now we're getting into some of the other sectors reporting this week, but financials back on top, 1.2% higher. Materials, number 2, utilities, number 3. Earlier in the day, it was Utes and real estate at the top of the list, but looks like some other things have kind of jumped in to the upside party here. Energy and technology, your only negative sectors, and technology was essentially flat from Friday's close. So energy really the big loser today, down only 0.6%, but certainly lagging behind. Now with energy, right, it's all about crude oil prices. I mean, there are nuances about different companies and what they're doing, but at the end of the day, it's usually a play on crude oil. And as long as crude oil prices remain fairly muted, which is what they've been, down again pretty big today, as we mentioned, right, crude oil, as long as crude oil, the chart of crude oil remains weak, there's not a lot of reason to be looking at the energy sector, I would say, from a technical perspective. That's kind of what you're waiting for. You're betting, if you're buying energy here, betting on crude oil prices going up, and they have very much not been doing that recently. Couple other things here on the old dashboard, breaking down the market activity, looking at the Magnificent Seven and Friends. Now, it's worth noting 5 out of these 8 names are reporting earnings this week. So it's a busy week between now and Friday. I mean, we may get quite a bit of clarity in terms of how some of these mega cap names are reporting and what they're saying about their quarterly results. Certainly expectations going forward. And also, AI and related themes, which have been a big driver of this bull market and driven a lot of these names to arguably excessively high valuations. We may get some clarity on their expectations going into the beginning of next year. So certainly a lot of things to digest there. For today, what it's worth, Alphabet, Meta, Apple, all up about 0.9% from Friday's close. The only one really down a lot was Tesla, down 2.5%. Tesla, of course, gapped higher, over 20% on their earnings release. That was Thursday, if I remember right. And for now, kind of giving back some of those gains. NVIDIA and Netflix all down in the red as well. Looking at the market carpet here, sort of an interesting day. You can see Tesla kind of stands out to me. And so the first thing we do is sort of look at the overall landscape. Not a bad day. And general themes that I'm seeing on today's heat map. Lower left corner, you have financials. And I'm noticing from the financial sector quite a bit of green. And so you're seeing names like Citigroup, like Key, CFG, State Street, Discover, Synchrony Financial, SYF, all up to a pretty decent clip today. Like here's SYF making a new 52-week high. It looks like certainly a closing high today, up another 3%. So financial is sort of re-exerting itself in a leadership role. It's interesting that like Citigroup, JP Morgan, those are not charts that are really breaking out here. They're sort of still stalled out, either just breaking above resistance and not following through, or still waiting to break out. We'll look at the chart, I think, of Citigroup and JP Morgan. I think I saved those two to review with you here a little later in the show. But overall, that's one thing that certainly jumps out at me is just the strength that you see in the lower left. The general weakness that I see in the technology sector, that's in the upper left. And it's not just some of the bigger names. It's like IBM, Micron, MU, Cadence, Seagate. These are all names that are kind of in the red. In the upper right corner, I'm noticing some of the sectors that are sort of mixed. Consumer discretionary comes to mind as one with a lot of names up a lot. Some of the gambling names like Caesars, cruise lines like Carnival Cruises and Norwegian, both up in the green, but also some red. You have Bath and Body Works down, Tesla down, etc. The other general observation I would make would be the energy sector, pretty much weak. And again, as we've mentioned many times, that's a play on crude oil prices. Crude oil prices have not been going up. They've definitely been an underwhelming part of the commodity space. And if you're buying energy stocks, you're essentially indirectly betting on crude oil prices going higher. And that's just not the trend that I'm seeing. That's the kind of bet I would argue you want to make when you start to see accumulation in the area of crude oil, and I'm just not seeing it just yet. Certainly compared to things like precious metals, which have been in primary uptrends for quite some time. Second thing we like to do is hit on the big dogs, sort of the larger names, kind of mixed today, right? You can see Alpha that was a hybrid of Alphabet and Apple. That's what I did right there. Apple, Alphabet, Meta, all up almost 1%. Those are sort of your leaders in the mega cap space. AMD, though noteworthy, is actually going higher. And also, I would say, and I'm kind of mixing my game plan up here. Look at First Solar, Solar Edge. These are some of the renewable energy names. I mean, Solar Edge is still a remarkably bad chart. I mean, not a bullish chart yet by any stretch of the imagination. I mean, the primary trend remains lower as it is now below $20 a share, down from about $100 a share less than a year ago. However, days like today could be the beginning of a nice accumulation phase. First Solar as well, kind of bouncing off of that support around 190, 200, having a nice up day up over 3% today. I still think quite a bit to prove with some of those renewable energy names. Lam Research also in the semiconductor space, down almost 3%. So I jumbled my whole approach to these. By the way, if you want to learn more about the MarketCarpet and just ideas of how to use that, the three ways, thinking about the broad landscape, thinking of the large names, the big dogs, and then looking at some opportunistic opportunities on the Stock Charts YouTube channel. I put a video on not today, a week ago today, on using the MarketCarpet, using this heat map kind of visualization. Might be of interest to you. By the way, I just posted a video. I don't think it's live just yet, but just did a video, 5 different breadth charts. I'll show you one of those here in a moment, but the breadth conditions certainly deteriorating. By the way, as a reminder, if you like what I'm doing here on the show and you want to learn more about market misbehavior, best thing you can do is go to marketmisbehavior.com/free course. I have a free behavioral investing course. I would encourage you to check it out. It's a 5-week email course, a video, and just some comments. I started this and I designed this course years ago, and I've just been updating it over time, but really is a way to just help you think about how you think about the markets. When I've worked with financial advisors and individual investors, and back in the day, a lot of institutional investors, a lot of times it's just unpacking and unwinding bad habits and reinforcing good habits. And I hope that free course kind of helps you along that journey. So if you want to learn more about that, and again, think about how you think about the markets, marketmisbehavior.com/free course is a really good place to do it. All right, let's continue on looking at the charts here, do a little chart review. The S&P 500, of course, still with today's sort of underwhelming gap higher, but trend lower, still above trendline support, though. And this is the chart that I decide to sort of use to reinforce, I think, the key the key message of a renewed uptrend or really a consistent uptrend, right? The primary uptrend for me is when you take a step back, does it look like a consistent pattern of higher highs and higher lows? And I would say that pullback that we experienced last week, the low that we put in on Wednesday of last week, and then a couple of days now we've drifted higher. We remain above trendline support, and that's a major support line drawn from the August low, the September low, and that lines up actually remarkably well with what we're seeing here in late October. And that actually is kind of an important lesson here. I think it's just in terms of trend line analysis, right? I was taught once is chance, twice is coincidence, 3 times is a pattern. The way that you know, or the way that you have a good idea that a trend line you're drawing is actually a pretty good trend line, a pretty meaningful trend line, is you connect 2 points and then it independently lines up with some third point later, right? And so when we first drew that trend line, that was kind of back here where we bounced off of that low. And I remember thinking, all right, let's connect the lows with the trend line. That's just sort of charting the pace of this uptrend. And as long as we remain above that trend line support, conditions are fine. If and when we break below that trend line, that might tell me that something's different, or at least I need to revisit that thesis that we're in a primary uptrend. So about less than a week ago, Wednesday, we actually traded right down to that trend line. And that's why I think it's an important one to just track, right? That trend line is a consistent percent gain on the semi-log chart that I'm showing here, where the y-axis is actually, the y-axis actually scaled by the percent changes, right? So 1% has an equal treatment all along the y-axis, which means when you draw a trend line on this kind of chart, that represents a pretty consistent percentage gain in whatever chart that you're drawing, whatever stock or ETF or index in this case that we're drawing. So as long as we remain above that trend line, the pace of this appreciation is consistent, which means if and when we break that trend line support, that tells me something's changed. And while it might not be a screaming sell signal, it definitely would tell me to revisit that thesis that we're in a nice, consistent bull market. But for now, My market trend model remains bullish on all time frames. The S&P continues to go higher, making higher lows and staying above trendline support. I don't see a lot of reasons to be concerned, at least on that chart. Now, there are some things to be concerned about. And again, I mentioned the video that I did earlier today for Stock Charts TV. Hopefully that's posted very soon on the Stock Charts YouTube channel. But one of the things we talked about were 5 different breadth indicators, looking at advanced decline data, the McClellan oscillator, stocks above moving averages, all things we've sort of touched on the show in recent months, but really just focusing on the message that they're telling us now on a review of those breadth charts. And one of the ones we talked with, the one we finished with, is this one. This is the bullish percent index for the S&P 500. Now, if you're not familiar with this one, this is a breadth indicator based on point and figure charts, right? Point and figure charts back in the day on the floors of the Chicago exchanges like the CBOE and the CME, in New York, like the NIBOT, the old school commodities and futures and options exchanges. I would work with traders and brokers who would use point and figure charts almost exclusively, and they would actually jot down the patterns. They would hand draw them. They would do it on different time frames. They would use it as a way of really tracking supply and demand, and then they would use those levels and those triggers in the pits to think about where they wanted to actually execute different orders. And so this is actually a breadth indicator derived from those point and figure charts. I was looking at 500 point and figure charts, basically saying how many of them are currently showing a bullish signal as the most recent signal. It's currently sitting right around 70%. You can see that red horizontal line that I've drawn, which represents the fact that for me, that is an important level to watch. What I have found using this indicator for years is when the indicator goes above 70%, which means 70% plus of the S&P members are all in bullish point and figure chart profiles. And then at some point, we go back below 70%. So think about what that means. Kind of everything's in a bull phase. Everything's going higher. We're all happy. We're all geniuses in a bull market. But then the market's still kind of hanging in there, but a lot of individual stocks are actually breaking down. And if you know point and figure charts, you know a sell signal means you're not just pulling back a little bit. You actually have to break below the previous column, which means you have to actually follow through to the downside enough to register a sell signal. So when this index goes up to around 80%, which it did about a month ago, and then comes back below 70%, that tells you about 10% of those stocks have now broken down. They were bullish before, but now they're no longer bullish. And often that will lead to a further decline as things continue to go lower and lower. Look to the left, and I've shaded in red when the indicator gets above 70%. Look particularly at the end of that shaded area, and you can see that most of the time, that's led to a pretty decent pullback. Not an end of the world pullback necessarily, but a tradable and certainly navigable downtrend or a pullback phase for the S&P. One where it did not happen particularly well was in mid-January. This is when the Magnificent Seven stocks kind of re-exerted themselves. If you remember the first quarter, it was all about the Mag 7 working despite the fact that other things were not. Breadth indicators all weakened. However, the indexes were powering to new highs because the Magnificent Seven stocks were so strong that the market moved higher despite the weakening breadth conditions. So it can happen. But what is much more common is that weaker breadth conditions speak to weakness underneath the hood of the markets, weakness that is not as prevalent or not as obvious if you're looking at the major averages. And usually that deterioration leads to further deterioration. So I'm watching this index closely. As of today, looks like at the close, it's remaining slightly above 70%. I would be watching this through the course of this week. If breadth indicators like this start to register sell signals, I would be concerned about the sustainability of the uptrend that we've experienced from August, September into October. Does that really continue into November? If breadth conditions are weakening to the degree that it looks like they might be, I would be concerned. Also notice the divergence, which was really telling in the bullish percent index there. By the way, I do see some questions coming in, and I appreciate it. Wherever, whatever platform you're on, pop a question in on X, on Facebook, on LinkedIn, on YouTube. I'll try to grab a question or two at the end of the show. If I don't have time for your question here on the live stream, I'll put it in the mailbag. We're planning a mailbag episode this coming Friday. I hope to answer one of your questions during that all mailbag episode. Let's talk about Bitcoin. I saw my friend Adrian Zadunchik posting some comments about Bitcoin testing that 70,000 level. We've been keying in on 70,000. That's that blue horizontal line that you see here. Alan Shaw was a legendary technical analyst, unfortunately passed away in the last year or so. But he had a lot of really fantastic knowledge that he was able to pass on to some of his mentees like Louise Yamada, Ralph Atkinpour, and others that I've been able to that have served as my mentors in a lot of ways. But Alan Shaw was famous for saying, the broader the base, the higher in space, meaning the longer that a price trend remains in a consolidation zone, a basing pattern. We have sort of a sideways pattern of resistance and support. We're kind of range bound. When we finally break out, the longer we've spent in that base, the more significant it is when we finally break out. And that is arguably what you may be seeing set up here. From that low in August, Bitcoin has registered a higher low in early September, a higher low earlier in the month of October, another higher low about a week ago around 65,000, and now is threatening that 70,000 level. Hasn't touched 70,000 since late July, where we found resistance and actually pulled back. Before there, look at all of those times that we tested resistance in that 70 to 74 K range. That's the level that we're kind of right back up to. So that means two things. Number one, you kind of expect resistance as we test the resistance yet again, right? The more that we test it, the more that it kind of validates that as an important ceiling for the market. But if and when we finally break out of that, that actually means significant potential upside, because that basing pattern is now broken, and all of that sort of consolidation, think of it as like a coiled spring, just sort of building momentum. Then it's finally released. And when you break out of that resistance, that means all of a sudden something's different, right? It's a change of character as we're finally willing to pay more for one Bitcoin than we have in months and months. This is a base going back to March. So I would say Bitcoin very close on a long-term basis of shining a pretty clear breakout here. I'd be looking for resistance in that 70, 72,000 range, which is where we've hit resistance many times over the last 6 to 8 months. Full disclosure, I do own Bitcoin in an account that I manage. All right. Continuing on, we'll talk about some individual stocks here to wrap up the show. And again, I'll take a question or two, and then we'll wrap it for the day. Let's start on a positive note, right? T-Mobile continued to go higher. Had sort of a noisy week last week, Thursday, pushing higher, moving above 230 for the first time. Friday, giving over half of that back and finishing the week around 225. You can see today trading a little bit higher here. I would say that primary uptrend still very much in play. And it's a reminder that, oftentimes when a chart looks like this, people will ask me, well, I missed it. Now what do I do? And I would say that you could argue that you missed it back here, right? I mean, when we finally break out, it's like, should you be happy buying a stock as it's making a new high? The answer is yes, if you want to participate in that next big move higher. Remember, every sort of 10x, right? Stock that went up 10 times, it first went up 2 times and then 3 times. So I wouldn't be afraid necessarily to buy new highs as long as you have a good money management approach, right? As long as you have some tools in your toolkit that are helping you participate in that ongoing uptrend, and then limit your losses if you do see enough distribution to trigger. And that's where moving averages can be helpful as a trailing stop. The chandelier exit system, which we've talked about on the show before, those are the types of things I would use to minimize drawdowns and just participate in an ongoing uptrend as much as possible. By the way, good luck tonight to the Seattle Sounders playing the Houston Dynamo round 1 of the MLS playoffs. I will be there with my son, which is pretty exciting. Not at T-Mobile Park, at Lumen Field right next to it, but we'll be heading into Seattle again later today. Tesla overall testing resistance. Tesla, one of the big stories last week, of course, gapped higher on earnings, created an island reversal, which is where you have a gap lower, and then soon after we have a gap back higher, creates like an island. Think like you're looking down onto a map, and you can see this is like the little island sticking out. That's why it's called an island reversal. But then that gap back higher is usually a really important signal, because it tells you that we've sort of renewed this bullish phase because we traded higher. Now, we had the big move of about 20% on Thursday. Friday continued higher. Today, though, we opened around 270 right at the July peak and sold off a little bit. So now we're testing resistance. We gapped higher. That's great. I would argue still the chart is fairly constructive here, but I'm watching this resistance level. I think Tesla above that resistance is a really meaningful chart, right? Go back to the chart of Bitcoin and others. So when you have that resistance, that means you expect resistance, but if and when it breaks, that tells you something's different. That's what I'd be looking for on the chart of Tesla. Today, down about 2.5%, one of the worst performers, actually the worst performer out of that Magnificent Seven group. In the financial sector, financials were your top performing group of stocks today. RJF, Raymond James, had a good week, gapped higher on earnings last week. Today, closing another all-time closing high, or certainly a 52-week high. Didn't quite get there on an intraday basis, but on a closing basis, it did. And I think the story with financials for me is the improvement in relative strength. The financial sector is one that I think a lot of people have forgotten about and or avoided, and it's mainly this period that you're probably still thinking of. And this is a period when financials are going down, when the indexes are going higher. The S&P is, pushing to a new high in June and July. And stock like RGF is going down. It's underperforming dramatically, so you're getting killed on a relative basis if you own the stock. But all of that has changed now, right? You're breaking out. Instead of hitting resistance at the April peak, you broke through it. The RSI now very much in a bullish range. The relative strength improving. This is a chart that's actually getting better. So it's encouraging to me that charts like this exist, and I'm finding a lot of them in the financial sector. Now, some of them have not quite broken out yet. For every RJF, I feel like there's a Citigroup or a JP Morgan, which is just not quite breaking out. Citigroup is a really interesting chart. Look at the peak in July. Look at how we retested that same level. This is a bit of a distribution pattern on your candle chart. I don't know what I would label. I'd probably label that a bearish engulfing pattern better than anything. But overall, a bit of a distribution there. We're finding support at a 50-day moving average. But again, I think this is a really compelling chart if and when we can get above that resistance from July and October peaks. It's not too far above current levels, about $3 above current levels. JP Morgan, same thing. We traded up to that late August high, but for the last 2 weeks, it's gone nowhere. Now, this is setting up for these, these sorts of stocks as we finish earnings season. It's all about whether names like this can power above resistance. As we've said, not just trade to resistance, but through resistance. I still think something to prove on both of those charts before I'd be very excited about it. Alphabet's another one. Now, Alphabet is one that's reporting earnings. They're coming out tomorrow with earnings. 5 of the Magnificent 7 stocks are reporting earnings this week. Significant market moving potential on any one of those. I would say with Alphabet, note the August peak, note the early October peak, the mid-October peak. Today's range, it's all right around that same level. I think this is a really strong chart. When it gets above 169 to 170, powers above that resistance, makes a new 3-month high. None of that has happened yet. For now, we're just languishing in no man's land between price resistance on the upper side and moving average support, where we've bounced off of October, early October and late October. So one of those things is going to break, right? Either we're going to break below moving average support or above price resistance. I'm happy waiting, sitting on my hands until we see it. One of you posted in the comment section earlier, I thought you took Livermore's advice and went fishing. And I love that. Yeah, and as mentioned, that's a famous Livermore quote that I love. There's time to go long, time to go short, and time to go fishing. I would say on the chart of Alphabet, it's one of those, right? It's a time to go fishing, to sit on your hands and be patient. Wait for the chart to tell you which way the direction of momentum is going to be. For now, I think it's sort of a wait and see mode. It's a pause that refreshes. Meta, another one. Now with a chart like Meta, it actually did break out in mid-September. We highlighted that gap above 540 as a significant follow through. Now from there, we've had a very classic pullback. We're staying above an ascending 50-day moving average. I would still say this chart looks pretty good. Last week's low, we saw the RSI bottom out just above 40. So I would say overall, the primary trend remains fairly constructive here. The question for earnings is, do we get that resumption of the uptrend? Do we get a positive catalyst that forces, confirms this higher low and sort of breaks out here? The bear scenario for some of these Mag 7 names is that earnings disappoint, we get back into this range, and all of a sudden we have to completely reset. It's like, hold on a second. Are we in an uptrend anymore? Are we holding the 200-day? Are we holding the September low? Those are all things we would need to figure out. For now, I think the chart is pretty good, but I think a lot is going to depend on what we learn about earnings here this week. 2 more charts to talk about. ConocoPhillips is one of the energy stocks. On Friday, it becomes kind of energy day. You have Exxon, Chevron, ConocoPhillips all reporting here Thursday into Friday after a lot of the growthy names. ConocoPhillips is a really interesting chart because it's bouncing off of support. We're right around 102, 103. That's the low from August, September, another time in September. Now again today, all bouncing off of that same level. Above there, you have resistance at the 200-day moving average where we hit in July and in August and in early October. So similar to the Alphabet chart, we're sort of in that no man's land between support and resistance. Again, I think ConocoPhillips and other charts like this are a play on crude oil. I would not argue that the crude oil chart is necessarily strong at the moment. So I'm happy sort of being a casual observer of these energy charts until and unless you see an improvement in crude oil beyond what we've seen so far. Finishing on a positive note here with the chart review, we'll look at Home Depot. Home Depot is a chart that I love to bring up as an example. It's kind of a nice liquid name, always some interesting examples to pay attention to. Look at the peak in March. Look at the breakout that we experienced in September. We're now pulling back a little bit, kind of between here and 390. That's where you'd normally expect kind of that support to come in. RSI stabilizing above 40. This could be that time to sort of buy on the dips and ride the price higher. It's found support at moving averages a number of times here in the last 6 months or so. I like this setup. I like the fact that we're holding support. They actually report earnings a couple weeks out, coming up on November 12th. But for now, I would say that's a nice chart as long as we can remain above 390, because that's the March high. That's also the 50-day moving average. So a lot of these that have broken out have kind of stalled out. I think there's a clear level to watch. Meta, same kind of chart, right? And keep those in mind. That's your line in the sand. As long as we hold support on any pullbacks, primary trend, as far as I could see it, still pretty positive. All right, let's take a question or two to sort of finish things off. I'm going to ignore, again, your pro-Yankees banter. You can keep it. I'm cheering for the Dodgers, actually, mainly because they're not the Yankees, so don't read too much into that. Let's see, what can we do here. All right, question from YouTube. I've noticed that SPGI always leads the S&P during corrections. Have you ever looked at this? It has since 1987. SPGI. I think you mean S&P Global. I'm guessing you mean. So if not, drop a comment. Let me know if you mean something else. So you're talking about the chart of the S&P S&P Global as leading the S&P 500. That's an interesting theory if that's what you're referring to. I mean, the argument would be, there are a bunch of, all the exchanges are publicly traded now for the most part, right? They're all sort of owned by, it's like ICE, SPG. These are all essentially market data providers at this point, even though they're, some of them are technically exchanges. None of them are. And SPGI is kind of in that specialty finance group with, let's see, like the NASDAQ and ICE and the CBOE and all of those. They're all kind of conglomerates that are essentially market data companies. I don't know about the lead. I don't know about it leading the S&P 500. I don't know if I would go that far. I would tell you that the bearish divergence is remarkably strong at the moment. What I mean by that is, look at SPGI, the peak in September, the peak in mid-October. Look at the momentum that is completely dried up. So we make a new high in early September. We're overbought. We make another new high above 530, and the RSI is right around 60. That is a classic bearish momentum divergence. So the fact that we gapped lower after earnings last week is concerning. We've now gapped below the 50-day moving average. The RSI now well below 40. This is no longer showing the configuration of a bullish trend. It's actually showing the configuration of more of a bearish trend. And it's not a gap lower and you see a bunch of buyers coming in and pushing the price from 500 back up to 520. You're seeing additional selling, which means we gapped lower and people are taking this as an opportunity to unwind even more. When charts like this are leading and making new 52-week highs, and then you see downside gaps that are not filled, you see momentum that is weaker as we make new highs. You see momentum rotating more to a bearish direction. That's concerning for me. So while you are seeing some stocks like RGF in the financial sector looking quite strong, this is one of those that I would argue not nearly as strong. So this kind of shining a lot of sell signals here recently. CRM chart. Yeah, Salesforce. Great question. Have not looked at that one in a while on the show. And I think about Rauf. Thanks so much for asking about CRM. So pretty interesting development, I would say, from a technical perspective, which you have to remember, think about that gap that we just looked at on SPGI, right? Think of that same sort of thought process here in late May. We gapped lower, and from that point on, that's been the low, right? So we gapped lower in late May. All of a sudden, there's a bunch of buying that came in. That was on earnings, the Q earnings in late May, basically. And then they reported again here just, end of August, which is right around here. We traded a bit lower, but overall, we've continued to build momentum after that gap lower in May. What was interesting about the chart of CRM was this pattern right here, where the 200-day moving average was sloping higher, but we were unable to make our way above there. And then everything changed here. Finally, we were able to break above the 200-day, find support. Look how that lines up with this sort of gap back here. We've now completely filled the gap. And now we've moved higher. I see this as a chart now in a primary uptrend. This is the kind of chart I'd be happy to ride further to the upside, watching the overhead resistance. But this is the type of chart I would consider innocent until proven guilty. Do you agree? Do you disagree? Drop a comment and let me know. Folks, that is it for the show. I want to thank you so much. Sorry for the late start, but again, I had a chance to meet my friend Sean McLaughlin in Seattle for lunch. I couldn't pass the opportunity, so I appreciate you hanging in as you did the show a little later than usual. Thanks so much for tuning in live if you're doing so. Thanks for watching the replay if you are. Appreciate you tuning into our podcast. We released over the last week conversations with Peter Schiff and have a conversation with Mike Turner, probably ready to release today or tomorrow. And one more with Adrian Day, some really good trend following economy, sort of broad market discussions to nudge your thinking. Who else should I interview for the podcast? Give me a comment and let me know. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great night, folks. Bye-bye.